Hello, and welcome to Track Your Dividends. In this video, we are going to be looking at the top 5 dividend stocks for November of 2020. We decided that for this list it would be best if we chose one dividend stock from 5 different sectors. This will diversify our list and give us a good understanding of different dividend stocks across multiple sectors. When looking at each stock, we are going to briefly go over what the company does, the growth of the company over the past 5 years, and then we will look at their dividends and their dividend history. So, without any particular order, let's begin with the first stock on our list. The first stock in our list is going to be Intel Corp, ticker symbol INTC. Intel is a leading manufacturer of essential products and technology that help to power the cloud and many data centers around the world. While you may know Intel for their consumer CPUs and laptop CPUs, which recently haven't been performing very well compared to their competition, who is mainly AMD, a large part of Intel's revenue comes from their data-centric business sector, which has been growing and powers much of the cloud and other data centers today. Looking at Intel's revenue over the past 5 years, we can see a strong growth, growing from $55 billion to $71 billion in revenue, a 29% increase. Over the same time period, they had an average yearly increase in revenue of about 7%. And looking into Intel's dividends, their annual payout forward and their forward yield are around $1.32 and 2.9% respectively. This annual payout is an increase from $1.26 in 2019. Intel pays their dividends quarterly and have been growing them for 6 consecutive years. Now, this is a very short growth period, but over this period, the dividend has grown roughly 7%, with a growth rate of 4.76%. All of this is very good for Intel, and this is further confirmed when looking at Intel's dividend safety score on TrackYourDividends.com. The biggest issue with their safety score is their consecutive dividend growth, as they've only been growing it for a very short period of time. However, with Intel's revenue and their earnings per share growth, they are looking on track to continue growing their dividend at the current rate of roughly 5% per year. The biggest advantage to Intel's dividend over some of the other companies that we will later list is that their stock is severely undervalued at the moment due to delays on their consumer products. However, many people do not consider or take into account Intel's data-centric centers and their client computing group, which combined bring in more than 60% of Intel's yearly revenue and are continuing to grow more and more with each year. The next stock in our list is Realty Income Corp, ticker symbol O. Now, we've already done an in-depth analysis on this company, so we will only briefly go over them in this list. Realty Income operates as a real estate investment trust, and as you may be able to guess, they are part of the real estate sector. They purchase properties and lease them to commercial companies on 10 to 20-year leases. Over the past 5 years, they have seen a very strong growth in their rental revenue, growing 53% from $980 million to $1.5 billion, with a 10% growth per year. Currently, their dividend yield sits around 4.34%, with a forward annual payout of $2.81. One of the great things about this dividend stock is that they pay out their dividends monthly, and they see growth 5 times per year. The dividend growth has been very stable over the past 10 years, with it being around 5% growth. And they have been very good with their consecutive dividend growth, growing for the past 23 years. Looking at their dividend safety score, we see that the best thing about this dividend is their stability and consecutive growth, with very good EPS trends and yield. If you'd like to learn more about this stock and their dividend, then make sure you check out our in-depth analysis video. The link will be in the description. Moving on, the third stock in our list that we will be taking a look at is Costco Wholesale Corporation, ticker symbol COST. Costco is an international chain of membership warehouses that carry brand name merchandise at substantially lower prices than typically found at conventional wholesale or retail stores. Looking at Costco's growth over the past 5 years, they have seen quite a substantial growth in revenue, bringing in $166 billion in August of 2020 compared to $118 billion in 2016, a 40% growth. On average, Costco saw a 9% growth per year in revenue. Right now, their forward dividend yield is sitting around 0.76%, and their forward payout is $2.80. Costco pays their dividends quarterly, and each quarter the dividend is around 70 cents. Their dividend yield may seem low. However, looking into the dividend's growth over the last 10 consecutive years, the dividend has grown 15%, with the last year seeing a growth of around 9%. This growth saw the annual dividend payout increase from $2.52 in 2019 to the current forward payout, which is again $2.80. While the growth over the last 10 years has been very good, the fact that they've only grown their dividend for 10 consecutive years should inspire some caution. Looking at Costco's dividend history, we can see that they have grown very well over the past 10 years, and looking at their dividend safety score, we can see that they are one of the safest and strongest stocks on our list. The only real downside is how short their consecutive growth rate is. However, looking at their dividend growth over the last 5 years, alongside their EPS for each year, we can clearly see that Costco has a lot of room to continue to grow their dividends at a substantial rate, with each year seeing them make plenty more profit per share than the dividend they are paying out. This only gets better when you consider that the revenue is also growing at a very strong rate as well. Moving on to the next stock on our list, which is JPMorgan Chase. Ticker symbol JPM. JPMorgan Chase is a leader in investment banking, financial services for consumers and small business, commercial banking, financial transactions, and asset management. They are part of the financial sector and compete with other companies like the Bank of America and Goldman Sachs. Over the past 5 years, they have seen a substantial growth in revenue, growing 23%, from $89 billion to $110 billion over that time, with a conservative estimate of their yearly growth being around 13% in revenue. This growth is very good and gets even better when you consider that recent years they've been growing slightly higher percentages rather than previous years. Looking at JPMorgan's dividends, they are paid out quarterly and currently they have a forward dividend yield of around 3.09%, with their forward annual dividend payout being $3.60. JPMorgan also has a strong dividend growth, with their annual payout in 2019 being $3.30. The biggest downside for this stock is its consecutive growth rate, only having grown consecutively for the past 10 years. This is an okay length of time, but it's not great. Moving on to their dividend history, we can now see that even though they have a short consecutive growth rate, over that short time, their dividend has grown 20%, with their yearly dividend growth rate being around 9%. Adding earnings per share to this chart, we can see that broadly speaking, JPMorgan does a very good job of earning enough profit per share to pay out their dividends each year. Now, taking a look at TrackYourDividends.com's dividend safety score, we can see that this dividend is a very safe long-term investment, with good EPS trends, dividend yield, payout ratio, and growth rate. As stated earlier, the biggest concern with this dividend is their consecutive dividend growth. Finally, we'll be taking a look at Abbvie Incorporated, ticker symbol ABBV. Abbvie is a global biopharmaceutical company that develops and commercializes advanced therapies in different areas of healthcare, such as eye care, virology, immunology, and many others. They are one of the largest companies in the healthcare sector, and their biggest competition is Gilead Sciences. Over the past 5 years, Abbvie has seen a strong growth in their revenue, growing 50% over that time, with a conservative estimate of their yearly growth being close to 12% revenue. However, it is worth to note that in 2019, they only saw a growth in revenue of around 3%. And while that seems very bad, they have recovered and so far this year have grown even more in revenue than before 2018. Moving on to their dividends, currently they pay a quarterly dividend of around $1.30, with a dividend yield of 5.26%. Currently, their forward dividend payout annually is $5.20, with 2019's payout being $4.28. This is a substantial growth in their annual dividend payout. This growth is also shown when looking at Abbvie's dividend growth rate, which is 20.86% for the past 5 years, and 10.25% growth rate per year. However, like with JPMorgan, the biggest issue with this stock is its consecutive dividend growth, with Abbvie's only growing for 7 years consecutively, which is a very short time. This issue is compounded by their large growth rate and high dividend yield, which may raise concerns about whether or not they'll be able to consistently keep growing their dividends, especially at their current rate. However, looking at their dividend safety score, we can see that they have very good EPS trends alongside their dividend yield and growth. Looking at their dividend history alongside their earnings per share, we can see that like JPMorgan, Abbvie have also historically done a good job of balancing their dividend payouts with their earnings per share. Thanks for watching our video on the top 5 dividend stocks in different sectors for November of 2020. Did you agree with our brief analysis of each stock? Are there any dividend stocks we missed that you think are better buys? Let us know any thoughts or questions you have in the comments below. Also remember to like and subscribe so you don't miss out on our next in-depth stock analysis. And remember to check out our website, TrackYourDividends.com, so you can easily keep track of your stock portfolio.